Securities offered through TJ Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Protect and Grow with Chicagoland certified financial planner Tim Stearns of TJ Stearns Incorporated. Trust, respect, and results. TJ Stearns Incorporated focuses on comprehensive financial planning and benefits.
And welcome into the program. This is Protect and Grow Chicagoland Retirement. And along with us, as always, is Chicagoland's CFP certified financial planner, Tim Stearns, helping to uncomplicate the financial world, giving us a common sense approach to what we need to be doing and thinking about with our money in order to achieve our financial goals and a little bit of confidence moving through retirement. Tim, we always appreciate your insight.
Thanks, Peter. Thanks for having me.
Always a pleasure. And Tim, today we're going to be talking about financial surprises and maybe how to avoid them or how to be more confident when they do occur. I mean, I think we'd be hard pressed to say that we are going to completely eliminate financial surprises. There are going to be some that are going to be out there and catch us off guard.
Yes, and that's why I think it's pertinent to if anyone out there wants to give us a call, we'll be able to get them the 7 financial myths that we're going to go over today.
Yeah, and this report, this resource, the 7 financial myths, common planning misconceptions or mistakes. Tim, unfortunately, we find that a lot of savers and investors base their financial future on these things, on these myths or misconceptions that we could say are anything but dependable. And if we are relying on them, our plan is only as good as the assumptions that it's based on.
Well, let's just launch into it then. I mean, number one, the market always goes up. Right. You know, I see a lot of buy and holds coming into our office, people who are paying to have their money managed. And I use italics with that because really all they're doing is dividend reinvestment. And at that point, you're not really getting the bang for your buck that you're supposed to be getting managed money. Yeah. So the market always goes up. I mean, that's what your broker is going to want to tell you. But that's not always the case. Look at 2000 through 2012, the lost decade, we like to call it. It was actually about 12 years. The market did a lot of squiggly lines, but at the end of the day, it ended up exactly where it was. If you're in retirement and you're most baby boomers out there, you have a 401k. So you have a finite amount of money, you're retired and you're pulling money out of a lost decade. Well, the portfolio is stagnant. You're actually pulling out, money that could be earning money in the market, right? Is the theory, but actually you're taking out more because if the market, it depends when you take it out. Secrets of returns risk is a huge thing that I'd say 9 out of 10 Americans don't even know what that is. Yeah. Well, basically go ahead.
Oh, well, I'm in a couple discussion forums that give me food for thought and fodder for conversation on this program. One of them is a retired or preparing for retirement discussion forum, and a contributor in that forum had posted discussion. It's a pretty common question in that forum, actually. How much do you need to retire? And everybody wants just a blanket answer. It seems like when it's as we've talked about, Tim, a very individual answer to that question. But his question went into more details, and he said, we can just rely on an 8% rate of return in the market. And I responded, we can do anything but rely on or count on an 8% rate of return in the market, because as you just stated, I quoted some of what you have talked about on this program back, the period from 2000 through 2013. It was a period where we saw 2 different 100% returns in the market. And if you can have any 10-year period that returns 100% twice, you'd think it'd be a fantastic period. But in fact, from 2000 through 2013, there was a net of 0 gains in the S&P 500 index, Tim. That would be a tough time to validate that we can count or rely on an 8% rate of return for our financial future.
When I first got in the industry in 1994, we were relying on 10%, and that's my next thing, the 10% average market return. That's another myth. That's not a thing. And, the market has been they like to, I like to call it, the W, it's up, down, up, down, up, down, and what you're looking at is that you see people thinking that they're going to have a 10% average return. And I'd love to see that. But most financial plans that I've seen, when I say to someone, do you have a written plan? Well, yeah, my broker did this, showing me 8%, 9%, 10%. The market does not go up every single year by 10% at a clip, or even 8% at a clip. It's got pullbacks. It's got, times that it goes higher than 8, 9, 10%. But at the end of the day, the averages are, when we do a written income plan for people, we can use 4, 5, or 6%. We don't go above that because that's not real. You have to be ready for the rainy day, as I like to say it.
Well, at this point in time, Tim, I don't think any of us should be surprised by downturns in the market. We have seen them. We know they occur. There are regular business and market and economic cycles where there will be downturns, and yet so many people's plans rely on a steady, consistent, positive rate of return, whatever the average is that you want to feel comfortable counting on in your plan. The problem is, Tim, that it's not going to happen consistently. And therefore, as far as the plan goes, it's almost an unexpected surprise that sends us completely off track whenever there is a market downturn. And I know that's one of the reasons why you take the time to help people better understand that and carefully examine the assumptions that their plan is based on, that their financial future and quality of life is based on, when you're helping them construct that written retirement income plan. And ladies and gentlemen, that's one of the true values of the program, that if you would like a protect and grow plan, if you would like that individual customized retirement income plan that has been crafted with the help and assistance of a CFP, a certified financial planner for your specific situation, pick up the phone and give the Protect and Grow program, the show, and Tim Stearns a call at 800-640-2256. That's 800-640-2256. The true value of this program is that you can get that plan in your hands, no cost, no obligation. You can request this report that we will be referencing today, the 7 financial myths, the common planning mistakes and misconceptions to carefully reconsider, or that individual customized Protect and Grow and written retirement income allocation plan. 800-640-2256. That's 800-640-2256. 800-640-2256. And Tim, that's almost 2 myths kind of rolled up in one. The first being the assumption in a lot of projections that the market is always going to go up, never have a single down year into our financial future. And then the second one is the reliance on some stated rate of return, whether it be 8 or 10 or 12%, neither one of those. I mean, those are 2 distinctly different financial myths. Neither one of them can be counted on and relied on. And yet so many people's futures do.
Right. And the other thing that we've talked about a lot in my retirement classes is people say, well, is 4% safe to take out? And that comes from a gentleman who created that back in the 90s, using stocks and bonds, like a blend of that. And he said that if you took out 4%, which, a year out of, let's say, $1 million, that you wouldn't run out of money. To this day, he doesn't use that theory anymore because he found that 67% of the time it was failing through the 2000s. So, and he had created for institutions. So it's not really fair, but a lot of people picked up on that. And a lot of people thought 4% is a good amount. Well,
important distinction, though, that model was based for institutions. These are, investors, not individuals, not me relying on my own accounts. This is how pensions are funded and how institutions invest their money to create the income that they derive into the future, not that a single individual relying on their own funds can count and rely on it. And yet it was adopted by individual investors and by Wall Street, who told individual investors they could rely on it.
Right. And again, it fails 67% of the time. And, one of the things I ask tongue in cheek, in class is, if you get on a airplane and the pilot comes over and says, there's a 67% chance we won't make it to our destination, do you stay on the plane? And everyone gets a chuckle, right? But at the end of the day, no, you would never stay on that. So you can't do that in retirement. Nowadays we're seeing 30+ year retirements, for a husband and wife. And so you need to make sure that you're cognizant of the fact that you can't have money running out, and using a 4% rule is not the way to do it. You need a written income plan. And if you don't have that, shame on you if you want to retire, because that's the way to do it right.
Well, if you would like that written retirement income plan that has been reviewed and analyzed and constructed by a certified financial planner, this is your opportunity to get that put together, ladies and gentlemen. Not only looking at your sources of available income, such as Social Security and or pensions, and helping you maximize those, therefore minimizing the strain and stress and reliance you'll place on your personal assets, but also mapping out how to use those personal assets to fill in the income gaps and giving you an order of operations to be the most efficient. Pick up the phone, give a call. That's what the Protect and Grow and the Written Retirement Income Allocation Plan is all about. That's what it does for you. And Tim Stearns, Chicagoland's CFP, offers to put those together just for being a listener to the program. Give a call, 800-640-2256, 800-640-2256, 800-640-2256. And Tim, a lot of people actually underestimate the amount of income that they will need in retirement because they have not gone through that process of really defining it. And the amount that we're spending, that can be a pretty big surprise.
Right. And that's leads me to my next point, is that number 4, taxes will be lower in retirement. It's not like once you retire, the IRS says, oh, good luck to you. And they have a plan for every dollar you've ever made in your life. Right.
Sure do.
So you have to sit, and so you have to make sure that you understand what is going to be my tax bill. You're going to be your number 1 bill besides healthcare in retirement. So I have people go through the labor of making a budget for me, so we can see kind of where they're at. And usually the taxes haven't gone down that much at all. And every day is Saturday. They're using more money. They're going out to eat more. They're going on trips that they never got to do. So they're pulling out money. And we say, do you have a time bomb in your portfolio? And that being the tax bill, and and God forbid something happens to you, if you leave it to your family, they have to drain it within 10 years because of the Secure Act. That's another scary part to me, is people don't know what the Secure Act is. The days of the stretch IRA are long gone and dead. And so now you have to, taxes are I don't see them going down. They're the lowest they've been in forever. I mean, right now is it maybe a great time to do a Roth conversion, but taxes will be lower in retirement. Another fallacy.
Yeah, things that many plans are based on that we need to carefully re-examine, ladies and gentlemen, not to mention the regular surprises that we will see in the financial world that come before us, that we have into our financial future. But these are things that many people's plans are based on today that could be myths or misconceptions that could surprise us into the future if we are reliant on them. The fact that our need for income will be lower in retirement, the fact that taxes will be lower in retirement, if we assume that, and that's not the case, then we're pulling out more than we expected. We have higher costs and higher taxes, and that's not a recipe for success. So you need to carefully examine this. You need to forecast this and map this out. That's part of the Protect and Grow Written Retirement Income Plan. If you'd like to get that put together, pick up the phone, give a call, 800-640-2256. That's 800-640-2256. Tim, there may be a case where somebody could reasonably justify that they will be paying lower taxes in retirement, I suppose, if we are making a pretty significant amount of income and yet keep our expenses pretty low. We're pretty frugal. If we're making $150,000, $200,000, $300,000 a year, but our actual expenses are like $4,000, $5,000 a month, maybe we could justify that taxes will be lower for us in retirement. But unless we are staring at a pile of money at the end of every month and it's wondering what we're going to do with it, unless there's a whole lot left over at the end of every paycheck, then in all likelihood, our taxes, our expenses are going to be about the same. Because I know that I'm either at work earning money or it's the evenings or the weekend and I'm out spending money. Well, in retirement, every day's a Saturday, and it's kind of every day's a Saturday on vacation. And when I'm working, my money's kind of already been taxed. In retirement, when we're creating that income, it's yet to be taxed. We have to account for that. And a lot of plans simply don't. They don't address those factors.
I agree. And that's something that needs to be addressed. And, it seems like everyone is reactive to taxes. Why not get ahead of it, and figure out kind of where you're at? I see a lot of people who just kind of, are trying to wing it. And that's not the way to do retirement at all. Do a written income plan. My next one is number 5. I don't need life insurance once I retire. A gentleman that I'm meeting with the other day, he had over $4 million. I said, they've talked about lowering the estate tax. It's going to sunset in 2026 back down to 5 million. If he keeps growing that account, it's going to be above that threshold. But also they've talked about in Washington moving it down, and that's another reason to have life insurance. Pennies for dollars of benefit. And it's tax free to your children. That's another reason to do it. You didn't work your whole. What I said to him is you didn't work your whole life to pay the IRS a huge estate tax. So these are things that we help him plan with. The other thing is it's earning money. It acts like a Roth, because it's after tax dollars, and this life insurance policy. And then lastly, and probably most importantly, it's got long-term care benefits, living benefits, so that you can use them while you're still alive. 7 out of 10 Americans are going to need long-term care insurance, and 9 out of 10 of us don't have it. So this is just another way to do that.
Well, I think for any individual that has children, has a spouse, has a mortgage, has debts, has an income that needs to be replaced,
Sure.
Life insurance is part of our financial planning process. It's part of the care that we have for those around us. It's a necessary part of most financial plans, but we could easily fool ourselves, Tim, on the day that we retire saying, well, I don't have a paycheck that I'm trying to replace. I've paid off, my debts. The kids are up and grown and out of the house, no longer dependent. I've got this big lump sum in my retirement account, so I don't need life insurance. But you've just mentioned several reasons why there is still an appropriate argument to be made for the time and place and the necessity and value of life insurance as part of our plan. I remember several years ago, there was kind of a 2-year opportunity, I'll call it, where the estate taxes were waived, and George Steinbrenner, he was the owner of the Yankees, he passed away during that period of time. And it's like, oh, he was so lucky to die when he did, because he got to pass on his full net worth essentially without estate taxes. But we don't want to count on being lucky. And we know, especially for those with reasonably sized asset value, and the projection that it does continue to grow, we've got to do some pre-planning right now. It's kind of a use it or lose it opportunity if we may find ourselves above those estate tax limits into the future, or we want to protect our family from those potential costs of care.
Right. Get ahead of it, right? So, that's a huge thing to do. With the Secure Act, which I marvel that people don't know what that is. These are things that, to pass on the money to your heirs, they have to drain it within 10 years. So there's going to be taxes on there, and you have people who are in their earning years, getting this money from, like an IRA, for example, that was left to them. And next thing you know, they're paying a lot of taxes. So life insurance would help offset that. And as I said, what does Tom Hagner always say? Don't leave your family money, leave them life insurance, right? Because it's tax free, and it won't be taxed at all, and it's quote unquote free money. So that's another thing. The other thing is number 6. I can rely on my investment plan for retirement. How did that go in 2000 through 2002? Market lost about 50%. You go to 2007 through 2009, another 50%. So you cannot rely on your investment plan. These people out there that are using asset allocation still are, they lost a lot of money during those 2 timeframes. They can't do that now. As you're going into retirement, you can't stand to lose 50% of your 401k. Are you going to go back to work? These are things that we need to address. The other thing I'm noticing is that these investment plans are all correlated. So when the market goes down, they lose money in their bonds and their stock portfolios, right? Why not get something that's non-correlated? What does that look like? It could be an annuity, it could be a CD, but something that will not be affected by the markets is another way to take, some of the risk off the table. So I love, the myth, I can rely on my investment plan. The quick answer is no. I mean, asset allocation has failed us 5 times in the last 21 years. So these are things we need to be aware of.
And yet, Tim, every time it does, we find that it's a surprise. It takes people and catches them off guard. We've seen it before. We can't say that those type of regular business market cycles don't happen. Now, the way that it happens each time might be a little different. But right now, what I'm paying attention to, what I'm hearing a lot of concern about, Tim, is usdebtclock.org, watching those numbers of the U.S. debt just tick up at an alarmingly rapid rate, $28 trillion and counting. The new currency that has been put in circulation just within the last 18 months, 20% of all dollars have been created in the last 18 months. Inflation running away from us. People are caught off guard and surprised by these things, but what this might mean for us in the future, we really should not be caught off guard and surprised by. We should be planning, we should be preparing, we should structure our plan based on the fact that we're going to see something unexpected happen. Too many plans are optimistic, but Tim, the process that you kind of take there with constructing the protect and grow plan, protect is the first word for a reason. You sort of act as though it's Murphy's Law and things can and probably will go wrong, but that gives your clients an extended sense of financial confidence. The fact that they've planned for those things, discussed them, and prepared themselves financially for what can go wrong.
Right. And that brings me to our final point out of the 7. It's too late. It's too late to plan. I don't have enough money. Well, that's not true. We can do more with less. And, I've had people go, oh, I didn't want to meet with you because I was afraid that you'd tell me that I don't have enough to retire and I want to stay retired, et cetera. Well, it's not unlike going to the doctor. You need to go and see exactly what's going on, and you'll usually feel better, or you're going to make some adjustments to make yourself feel better. That's what a retirement plan does, a written income plan. It's a retirement crisis in America. The majority of Americans are not adequately prepared for retirement. And at the root of this issue is that most of these people have never sat down and formulate a plan, and to, formulate to the point where they understand exactly how they're going to pay the bills for 30 plus years. Having uncorrelated assets, all these different things that need to go into that. And I would tell anyone who gives us a call, we have that book, Income Allocation by David Gaylor, which is an excellent book that would really tell people, you know what, yeah, I'll be okay. I read the book. I understand what I'm going to do. I'm going to sit down with Tim Stearns and get a plan together so that we know exactly how we're paying the bills. And then you have a growth bucket where you can do things like take that trip you've never been able to do. If you need some home improvement, on your house that you just have been putting off. These are things that, we make sure you're paying your bills daily, but more importantly, that you're going to have a great retirement.
Well, if you would like that book, Income Allocation, that is a book being used across the country by advisors who are looking to give their clients a better understanding of the risks that we do face in retirement so that we are not surprised by them, and how to structure the assets and the accounts to prepare to weather those surprises. It is the Essential Retirement Planning Strategy Guidebook, Income Allocation. If you would like a copy of that, pick up the phone, be one of the first 10 callers right now. These strategies do work best for those who have been serious about their financial future and avid savers. Over 500,000 saved for retirement. This is a must-read book for you. Pick up the phone and give a call, 800-640-2256. That's 800-640-2256. And if you would like to structure your own individual specific income allocation plan, part of the Protect and Grow plan, certified financial planner Tim Stearns will help you structure that plan. Even if you have a current plan already and you'd like to to make sure that it's complete, that no stone has been unturned, no hole has been left unaddressed. That is the planning review and strategy session that CFP Tim Stearns offers as part of this program. Simply pick up the phone to take advantage. 800-640-2256. That's 800-640-2256. 800-640-2256. Tim, as part of that review and strategy session, we were talking before the program about a couple things that aren't on your list. You said a lot of people are surprised by the amount of fees that they are paying. A lot of people are surprised by the fact that Medicare has costs in retirement. These are things that we need to understand upfront and ahead of time.
Right. The gentleman that I met with the other day, he didn't realize what he was that he was paying what they call a wrap account fee. And, they weren't doing any trading. It was reverse churning is a term that's become in vogue, where they just kind of buy and hold, and then they charge them every month for really not monitoring anything. This gentleman had 3 different accounts with this firm, and they were the exact same stuff in each account. So I would agree. I think you would agree that this is not diversification, and no trading going on, and the buy and hold in my mind is that you cannot do that anymore. And that's why one of our portfolios, the market went down in March 2020, 24%, and we only went down 2% because we timed out and we stopped losses, and that made us go to cash, which is obviously, the proof is in the performance. So we've done that. And then, a lot of people don't know about IRMA, which is what you're talking about, where if you're a saver and you're bringing in money per month, the government looks at you as having, too much income. They'll actually charge you more for Medicare, which is, ridiculous. That's your reward. I use italics yet again for being a saver. It's not fair. Most Americans have about $20,000 for their retirement saved up. Those people get the break. They don't have to pay as much for Medicare. But if you're a saver out there that had a 401k, a 403b, a pension, what have you, you're going to pay more. And that's IRMA. And people should look that up because that's a real thing.
Pick up the phone, give a call if you want to plan and prepare, if you want to examine your current outlook to see what assumptions it may be based on, and carefully review whether those are assumptions that you can count and rely on, or if you want to evaluate those further. Tim Stearns, with a certified financial planning perspective, can help you do that, construct the Protect and Grow plan, and also provide that book, Income Allocation. All you need to do to take advantage, pick up the phone, give a call, 800-640-2256. That's 800-640-2256, 800-640-2256. Tim, always a pleasure, and we appreciate you bringing these unexpected surprises to light and discussing how we can better plan and prepare for our financial future.
Happy to do it, Peter. Thanks again for having me.
Tune into Chicagoland certified financial planner Tim Stearns' full radio program on 890 WLS every Sunday at 11 a.m. and visit tjstearns.com for many valuable resources, including other great episodes of Chicagoland Retirement. Be sure to subscribe.
Securities offered through TJ Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.